first 246 years of our republic, we printed $10 trillion. 246 years, $10 trillion. Then in 18 months, we printed $10 trillion. If you doubled the money supply, what should have happened to the dollar? Should have gone down in half, exactly. What should have happened to the price of Bitcoin? Should have doubled. That's exactly what happened. Well, but it didn't just double. Yes, it did. It was about 13,000 before. It's about 26,000 now. It perfectly doubled. But it's down in the last few months. No shit, Sherlock. Have you seen this thing called Bitcoin futures? You can go to the day the Bitcoin futures ETF was approved. The day was the peak of Bitcoin priced in US dollars.
Over the past 2 years, Bitcoin, the largest cryptocurrency by market capitalization, has experienced turbulent price swings in both directions. It initially surged to an all-time high of $69,000 per coin during an intense bull market fueled by factors such as substantial money printing by central banks and the 2020 Bitcoin halving. About 12 months later, it plummeted to $15,500 due to the multi-billion-dollar FTX collapse. Afterward, it rapidly rebounded to over $30,000 as depositors sought refuge from a struggling U.S. banking industry. In April, Bitcoin experienced another sharp spike after BlackRock, the world's largest asset manager, applied for a spot Bitcoin ETF. However, critics and enthusiasts alike have noted that the cryptocurrency industry has largely remained stagnant in terms of prices in 2023, primarily due to the Federal Reserve's aggressive interest rate hike campaign. Some, like Real Vision's Raoul Pal, argue that macroeconomic conditions have a more substantial impact on cryptocurrency prices than the underlying fundamentals. They believe that as governments continue to print money, cryptocurrency prices will continue to rise, providing room for factors like scarcity and network effects to drive further surges. On the other hand, renowned hedge fund manager Mark Yusko offers a different perspective. He recently participated in a panel discussion alongside experts such as Timur, the director of global macro at Fidelity Investments, and Jim Bianco of Bianco Research. They discussed how current macroeconomic conditions in the United States influence the prices of Bitcoin and other cryptocurrencies. While Timur acknowledges the impact of macro events on crypto prices, he points out that Bitcoin lost most of its 2021 gains as the Fed began tightening monetary policy, suggesting the need for better macroeconomic conditions for Bitcoin's adoption curve to accelerate. Yusko, however, offers a unique viewpoint, emphasizing that one Bitcoin will always be one Bitcoin, and macro events are only temporary distractions. This perspective sets the stage for a fascinating discussion on the interplay between macroeconomics and cryptocurrency prices. Now, let's explore clips from this engaging conversation.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I mean, I wore my, Keep Calm, We'll Print More t-shirt for the macro panel. And yeah, macro matters, but it depends what we're talking about, Jack. So you asked the question about Bitcoin. Does macro matter to Bitcoin? And while I'll never argue with Urin because he's forgotten more about macro than I'll ever know, I'll just say that no, it doesn't, in the sense that one Bitcoin is one Bitcoin. It always will be forevermore. But we don't price Bitcoin in Bitcoin. We price Bitcoin in other things, other pieces of toilet paper. So if you happen to live in Turkey, there's never been a bear market in Bitcoin. Not ever, because the lira just went to shit. And if you live in Venezuela, there's never been a bear market in Bitcoin because the Bolivar went to double shit. And if you live in Argentina, now with talks of devaluation, again, Bitcoin just goes up. Now Bitcoin goes up and down in the U.S. partly because of this, right? So in the first 246 years of our republic, we printed $10 trillion. 246 years, $10 trillion. Then in 18 months, we printed $10 trillion. Come on, someone shudder a little bit when I use the T word. Y'all know what a trillion is, right? Y'all math majors, I'm going to shut the doors, make you sit here with us for 31,710 years, which I promise would be most unpleasant to listen to me for that long. And you got to spend $1 every second. That's 1 trillion. So 10 trillion. We printed 10 trillion. You can go to the day the Bitcoin futures ETF was approved. The day was the peak of Bitcoin priced in US dollars. Why? Because just like gold. Anyone looked at gold since the pandemic? Gold should have doubled. Read Chris Wood, okay? Gold has been the perfect store of value for 5,000 years. It's a long time, but it's been flat, dead flat at $1,900. Why? Because it gets spoofed artificially manipulated by JP Morgan, and they get fined every year $1 billion. And they're like, yeah, well, we made 20. It's the cost of doing business. You keep fining us $1 billion and we'll make 20 and we'll be happy. And they'll keep the price flat. So they've artificially suppressed the price of Bitcoin over the past few months. Why? Well, because BlackRock wants to buy it really cheap. There was a great meme the other day. Please don't sell your Bitcoin to BlackRock. Please don't be that person. But that's what's happening. And everyone's like, oh, when's the ETF going to get approved? And what's that going to do? It's going to get approved when JP Morgan and BlackRock decide it will be approved, just like GLD was held up for 2.5 years until JP Morgan could get short enough gold. So all of this goes to my last point, which is the title of the panel. Does macro matter? I mean, she stole our thunder saying probably, yes, probably. But actually, in our world, no. Crypto, digital assets, whatever you want to call it, actually are uncorrelated with traditional assets for macro reasons. Stocks and bonds are highly correlated, along with currencies and commodities, because they derive their value from the same things. GDP growth, inflation, interest rates, and corporate profits. Those four things have nothing to do with Bitcoin, Ethereum, Solana, anything. Nothing. Those things are driven by millennial adoption, okay? The tech itself, the regulatory environment, and changes in monetary supply. So there's a little bit of linkage there.
The panelists delved further into the discussion, emphasizing that Bitcoin's core dynamics are fundamentally linked to its adoption curve, driven by the inherent scarcity and decentralization built into the cryptocurrency. However, they emphasized that regardless of the robustness of these underlying fundamentals, Bitcoin remains a network asset, and its value is intricately tied to the growth of its network. If prevailing macroeconomic conditions are impeding Bitcoin's network growth, it is anticipated that price actions will generally remain stable until a significant shift occurs in these macro conditions. On a positive note, Timur highlighted that real interest rates, which he considers a major driver of macroeconomic trends, typically do not rise significantly higher than their current levels. Additionally, he noted that the Federal Reserve is nearing the end of its tightening cycle. The chartered marketing technician added that this situation sets the stage for a more favorable and smoother crypto cycle, potentially leading to a reacceleration of the adoption curve. Let's return to the interview to hear Mark Yusko's insights on topics such as inflation, money printing, and the banking industry.
Interest rates are rising not because of inflation. There's no inflation. Inflation is caused when there's excess demand and limited supply of a good or service. What we have is currency devaluation. When an empire ends, the reason it ends is because you consolidate the power at the top with your cronies, and you go on a spender, on a binger, and you spend a lot, and you don't have any money, so in the old days, you would go out and conquer other nations, and you take their stuff to pay for it. We can't do that anymore. It's frowned upon. And so what do? You just issue debt, and you stuff it everywhere. We stuffed it in the banks. Like literally, the banks were required to buy treasuries. Well, that was not a problem as long as interest rates were low. In fact, it was free money. JP Morgan had 0 negative trading days for 3 years. 0. Anyone ever trade with 0 negative trading days? If you talk to me, DM me. We'll go in business together.
To be clear, what he means by 0 negative trading days is every single day for a year they made money trading.
Every day.
Are you 252 for 252 in your trading?
No
There's
one.
252
No one.
trading days in a year.
And so
JP Morgan is.
Yeah, JP Morgan.
Is it
very
because
good.
they're good?
Yeah.
Or do they have some help there?
Well, no, it was a guaranteed trade, right? Because anyone here ever borrow at Fed funds? Nope. No one does, right? Who borrowed at Fed funds? The banks. So when Fed funds were 0, the banks would borrow at 0, and they would invest in treasuries at 2.5%, 3%. Riskless trade, levered up 11 times. Awesome. Awesome. Why did they do that? Because the banking system was bankrupt after the global financial crisis, so you had to reliquefy the banks. So you reliquefy the banks by holding interest rates at emergency levels, even though there was no emergency. And then what happens? Well, then the bank's balance sheet gets fixed. Well, now they want to make some money. we can't make any money if interest rates are zero. So we're going to raise interest rates. So anyone's deposit rate go up from zero? It's funny how that works. So they're still paying you zero on your deposits, and now they're lending, well, to anyone who will borrow, but there's no demand. But the few people that are borrowing that need to borrow are paying 6, 7, 8%. So NIMs have exploded, and bank profits are up. And banks, up until 2 weeks ago, were up 30+% this year. Now they've rolled over because people are kind of seeing what's happening, which is overall liquidity is actually contracting because best laid plans are you get everybody psyched about low interest rates and you get the economy back humming, you lie about the recession. There was a recession in 2022. Full stop. 0.9% year-over-year growth is a recession.
According to Mark Yusko, the U.S. Federal Reserve has persistently raised interest rates despite clear indications of severe weaknesses in the economy. He suggests that these rate hikes are aimed at bolstering the financial positions of too-big-to-fail banks like J.P. Morgan. Yusko contends that every metric the Federal Reserve uses to gauge the economy's strength is flawed and intentionally manipulated to mislead the American public. He provides an example of the non-farm payroll employment data, which has undergone downward revisions every month in 2023. For instance, the change in total non-farm payroll employment for June was revised down by 80,000 from 185,000 to 105,000, and the change for July was revised down by 30,000 from 187,000 to 157,000. These revisions indicate that employment was significantly lower than initially reported. Yusko argues that due to the lack of interest in restatements and adjustments, the Federal Reserve and major banks continue to manipulate the economy and asset prices without significant repercussions. Moreover, he asserts that this manipulation is why banks, particularly giants like J.P. Morgan, are charging high interest rates on loans while offering minimal returns on deposits. He raises the question of whether viewers agree that there is ongoing extensive manipulation of prices and economic metrics to deceive the public, and invites them to share their thoughts, comments, and observations in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.